Hi everyone! Hi Ma'am Priscilla, good morning. So my topic is basic principles of finance. So before we proceed to the basic principle of finance, let us know first what is finance. Ato sang ilailahon ug sa gining gitawag nga finance. So finance is a broad term that describes activities with banking, leverage or debt, credit, capital markets, money, and investments. So, ang finance ko no is all about money. So, sa tanan na itong makita nga nag-provide og funds is called finance. So, in short, finance represents money management. Since we already know what is finance, so let's proceed to the basic principles of finance. So there are 6 basic principles of finance. So first is principle of risk and return, followed by time value of money, profitability and liquidity, cash flow principle, diversity principle, and hedging principle. So first, let's tackle what is principle of risk and return. The principle of risk and return indicates that investors have to conscious both risk and return, because higher the risk, higher the rates of return, and lower the risk, lower the rates of return. For business financing, we have to compare the return with risk. To ensure optimum rates of return, investors need to measure risk and return by both direct measurement and relative measurement. So, in addition, according to risk-return trade-off, invested money can render higher profits only if the investor will accept a higher possibility of losses. So, example of this is we as investors expect a return when we put our savings in a bank, and they expect to earn a higher rate of return on stocks relative to a bank savings account. So, in short, investors expect to be compensated for delaying consumptions and taking on risk. So, the second principle is the time value of money, or TVM. This principle is concerned with the value of money. That value of money is decreased when time passes. For example, the value of $1 of the present time is more than the value of $1 after some time or years. So before investing or taking funds, we have to think about the inflation rate of the economy, and the required rate of return must be more than the inflation rate so that return can compensate for the loss incurred by the inflation. So, meaning this principle, the time value of money, means that the money we have now is worth than the identical sum in the future. Why? Because of the potential earning capacity. This core principle of finance holds that provided money can earn interest, any amount of money is worth more the sooner it is received. And I included here the formula of future value. So this is the formula. Future value equals present value multiplied by the sum and the product of future value interest factor, which is 1 plus r, or period interest rate, raised to the power of the number of periods. Let's proceed to the third principle. The third principle is profitability and liquidity. The principle of profitability and liquidity is very important from the investor's perspective, because the investor has to ensure both profitability and liquidity. Liquidity indicates the marketability of the investment. On the other hand, investors have to invest in a way that can ensure the maximization of profit with a moderate or lower level of risk. So, meaning, unlike risk and return principle, which states that the higher the risk, the higher the return, and vice versa. But the difference of this principle is that profitability and liquidity are not in the same line. So it means that they have inverse relationship because the more liquid a company is, it indicates funds that are confined to liquid assets, making them inaccessible for productive activities that generate profit or for investments. So, therefore, a financial manager must find the right balance between liquidity to ensure the survival of a company and also keep profitability maintained in order to give the optimal return for its shareholder. The fourth principle is cash flow principle. The cash flow principle mainly discusses the cash inflow and outflow. More cash inflow in the earlier period is preferable than later cash flow by the investors. This principle also follows the time value principle. That's why it prefers earlier more benefits rather than later year benefits. So it means that positive cash flow, not profits, pays the bills and represents money that can be sent and reemployed to make more money. Consequently, it is cash flow, not profits, that determine the value of a business. Example is Disney movies. Not only Disney make money on the movies, but it is also increases the number of people attracted to toys, theme parks, and rides. So if you were to evaluate the value, cash flow of the movies, you would want to conclude the incremental impact on related sales throughout the company. Incremental impact, guys, or incremental cash flow means the difference between the cash flows that will be produced with and without the investment or choice being considered. Next is the fifth principle. The fifth principle is diversity principle. This principle helps to minimize the risk by building an optimum portfolio. The idea of a portfolio is never put all your eggs in the same basket because if it falls, then all of your eggs will break. So put eggs by separating in a different basket so that risk can be minimized. To ensure this principle, investors have to invest in risk-free investment and some risky investment so that ultimately risk can be lower. So, meaning, in finance, diversification is the process of allocating capital in a way that reduces the exposure to any one particular asset of risk. So, in short, diversification of investment ensures minimization of risk. The last but not the least of the basic principle is hedging principle. Hedging principle indicates us that we have to take a loan from appropriate sources. For short-term fund requirement, we have to finance from short-term resources. And for long-term fund requirement, we have to manage fund from long-term sources. So, meaning, hedging principle from the word hedge, which means an investment that protects our finances from a risky situation. So, in short, this principle or hedging principle is a form of insurance. And for the conclusion, principles are important because it acts as a guideline for the investment and financing decision. So if we have a basic understanding of finance and its principles, then we will be able to make financial decisions effectively, and there is a higher possibility to become financially gainer. So that's all for the basic principle of finance. Thank you for listening and stay safe, everyone.